Welcome to my channel. The channel motivates students and researchers to polish their economic skills with a classroom PowerPoint presentation to understand the topic. Today we will discuss the role of monetary policy. Monetary policy: when a government decides to correct the problem of deficient and excess demand by using the interest rate to extend and curtail the credit supply in the economy, it comes under the purview of monetary policy. The basic component of monetary policy are: 1. Bank rate. It is the rate at which the central bank of a country lends money to other commercial banks. When it faced excess demand, the central bank increased the bank rate. Now banks needed to pay more, and they passed the burden to their customers in the process. Loans became expensive and thus reduced the money supply in the market. In case of deficient demand, the central bank reduces the bank rate and promotes loans to increase expenditure to correct the demand deficiency. 2. Open market operations. Government sells and purchases securities through the central bank. When faced with excess demand, the central bank promotes the selling of securities and reduces the money, which reduces aggregate demand, whereas, in the case of deficient demand, it purchases the securities, releasing more money in the market. 3. Cash reserve ratio, CRR. It is the part of the money that the central bank wants the commercial banks to maintain with him against its total deposits. They are bound to maintain the minimum ratio, CRR, as per central bank direction. During the time of excess demand, the central bank directs the commercial banks to raise the ratio, which means less money for commercial banks for their lending operations, reduces the money supply, and corrects the excess demand situation. When faced with deficient demand, it lowers the CRR and directs commercial banks to give more loans and spread the money supply to boost expenditure, which will solve the problem of deficient demand. 4. Statutory liquidity ratio, SLR. A ratio between the bank's liquid assets and its total assets is called statutory liquidity ratio, SLR. The central bank directs commercial banks to maintain SLR. When faced with excess demand, the central bank asks the commercial banks to raise SLR to reduce credit supply. Similarly, when faced with deficient demand, it directs the commercial bank to reduce SLR, then commercial banks have more money for their credit operations, which boosts the demand. 5. Requirement of margin. It is that part of the money that a borrower needs to make on its total borrowing to its commercial bank. On the central bank's direction, commercial banks increase the margin money requirement, making borrowing less attractive to reduce the money supply and address excess demand. At the same time, the central bank directs the commercial banks to reduce margin money requirements when a country is facing deficient demand, which leads to more borrowing and more disposable money in the hands of the public. 6. Moral suasion, informally guiding the commercial banks to be aware of the situation of deficient and excess demand and be liberal in deficient demand situations and be selective when faced with excess demand in their credit operations. 7. Credit rationing, focus on different sectors of an economy. Credit rationing is applied in which limits or quota is fixed for each sector. It is basically used when faced with excess demand and the central bank is asking to carry out a dear money policy. It is not applied when the central bank is following a cheap money policy and is liberal in credit creation. I hope the discussion is helpful. Don't forget to subscribe and stay connected for future discussions.